Welcome back. Today we answer a very practical question for Indonesia-style portfolios. If you can only hold three macro building blocks, IHSG equity, Indonesia 10-year bonds, and USD cash, which portfolio construction method actually wins? We'll compare classic 60-40, Risk Parity, Max Sharpe, and a more adaptive approach called Rolling Sharpe Optimization. No prediction, no market timing stories. Just a clean out-of-sample test. Here's the dataset and the three assets. IHSG represents Indonesian equity exposure. USD IDR represents holding USD valued in IDR. I assume 0% USD deposit rate, so it's pure FX exposure. And for bonds, we use IDR 10Y yield to build a bond proxy. The full sample runs from 2010 to late 2025, but we split it properly. Train period is from 2010 to 2018, and test period is from 2019 to 2025. Everything you're about to see is evaluated in the test window starting from equity equals 1.0, so it's a fair comparison. Now the battle card. What strategies are we comparing? 60-40 is 60% IHSG, 40% bonds. 60-30-10, we add a small 10% USD sleeve. Risk parity. Allocate so each asset contributes more balanced risk. In this test, it ends up around 20.6% IHSG, 54.7% bonds, 24.7% USD. Op Sharpe is Static Max Sharpe. We optimize once on the train period, then keep the weights fixed in test. Notice it pushes heavily into USD because it improves risk-adjusted behavior historically. Row Op Sharpe. This is the key one. Weights are not fixed. They move over time. What does Rolling Sharpe mean? Each rebalance date, the model looks back at recent returns, estimates risk return, and solves a long-only Sharpe maximization problem, then applies those weights forward. Let's go straight to the headline. The equity curves in test. This shows growth from the same starting point, so the ranking is visual. But I want you to notice two things. First, some portfolios finish higher, but their ride is rougher. Second, some portfolios look smoother, but they may give up some upside. In real life, investors don't fail because the final equity is slightly lower. They fail because the path is too volatile and they abandon the strategy. So equity curves are step one, but we need the pain chart next. This is the reality check. Drawdowns. Drawdown is the psychological cost of investing. It's also the reason most people quit at the worst possible time. You can see the stress periods clearly, especially around 2020 and later volatility shocks. Classic mixes can go deep underwater. The more risk-aware approaches tend to reduce the depth and duration of drawdowns. If rolling optimization can keep drawdowns shallow while still delivering decent growth, that's exactly the kind of professional improvement we want. Better risk-adjusted performance and a better chance investors actually stick with the process. Now, let's quantify the stability. Rolling portfolio volatility. This chart shows how portfolio risk evolves through time. In high-stress regimes, some portfolios experience volatility spikes. Others remain more controlled. This is also why a fixed-weight portfolio, even if it looks reasonable on average, can behave very differently when the market regime changes. Rolling methods aim to react to those regime shifts, not by predicting returns, but by rebalancing based on the most recent risk structure. This is the explainability slide, and it's the most important one if you want a method people can trust. Top panel, stacked weights, they always sum to 1. Bottom panel, the exact weight of equity, bonds, and USD. You can literally see the model's behavior. Sometimes it reduces equity exposure. Sometimes it leans into bonds. Sometimes it increases USD as a defensive sleeve. And the key point, this is not a black box. Rolling Sharpe is simply estimate mean and covariance from the rolling window, then solve a constrained optimization problem, long only, sum to 1, and rebalance. So the intelligence here is not prediction. It's systematic adaptation. Now we end with the scoreboard, because this is what matters in practice. Look at the test summary across: CAGR, volatility, Sharpe ratio, max drawdown. In the results, 60/40 delivers solid CAGR, but drawdown is heavy. Risk parity improves the risk profile dramatically. Static Max Sharpe has strong risk-adjusted metrics, but can sacrifice growth. Roll Opt Sharpe stands out for the highest Sharpe and the smallest drawdown, meeting the smoothest, most risk-efficient ride. So the conclusion is not one portfolio is always best. It's if your priority is sleep-at-night risk control, rolling optimization is extremely compelling. If your priority is maximum growth, you might accept more drawdown and choose differently. Thanks for watching.